Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're going to be learning to speak the language of the options trader. We're going to be getting an introduction to the Greeks. The native tongue of an options trader is Greek. But fortunately, we only have to learn 4 words today, but they have very significant implications for the outcome of a trade, profitable or otherwise. So get ready. We're going to be learning a new language today. Should be a really good discussion. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names out there in YouTube. Welcome to anybody that might be here for the very first time, but hello there. We have Jackson and Eva, Josh, JDLMI. Who else is here? Greg and Robert and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in our live stream audience. This is a Tuesday webcast series. We kick things off promptly at noon Eastern time each Tuesday. Now, I also want to let you know that my very good friend Kevin Horner is hanging out in the chats with us today. Kevin and I have been working together for years. He brings a ton of experience to this discussion. And his role today is just going to keep an eye on what's happening there in chat on YouTube. And if there are questions that come in and I can't get to those questions, Kevin's there to pick up my slack for me. So thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody listening, live or on the archive, to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn, so you can track Kevin down there on X at Kevin Horner CS is his handle. You can find and follow me on X at Cameron May CS, or you can jump over to linkedin.com/in and then /Cameron May CS again. That'll take you to my profile and you can give me a follow there. But I post frequently on both of those platforms, and if you reply to my posts, I just try to reply right back to you. It opens up that the channel of communication when the camera's not on. But let's get into this discussion. We're talking about the Greeks today. We're going to be learning what they are, how they might help a trader anticipate how a trade might go, profitable or otherwise. And by the end, I want us to be comfortable with speaking the native tongue of the options trader. So as we do this, we need to be aware of the risks associated with options trading and other approaches to markets. Bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for today's discussion. What I want to do today is set up just a hypothetical example trade, and then we want to explore the potential for reward and risk on that trade using something known as the Greeks. If you aren't familiar with the Greeks, what they can do is measure for us the primary drivers of success or failure, which are price and time and volatility. If you don't know what I'm talking about, I'll explain it. But we're going to use that example tool to go through examples of each of our 4 primary Greeks. We will be talking about delta, gamma, theta, and vega today. And by the end, you'll be surprised at how competent you've become in applying the Greeks to our example trade. All right, I'm going to have a little exercise for you at the end. So let's get right into this. And we're going to go right to the Thinkorswim desktop paper money platform. We find ourselves here on a 1-year chart of NVIDIA. I have the 3rd Friday expirations applied to the chart. Those are the red dashed vertical lines here. And let's just put ourselves in the shoes of a would-be options trader here. We're going to be doing bullish options trade today, just buying a long call, but then using that to introduce ourselves to these things known as the options Greeks. But what our trader may have noted through a close examination of NVIDIA over the last 12 months is that NVIDIA has sort of had this tendency to trade in about $20 ranges. So trades between, in this case, over the last 12 months, between 173 and 193, and then it seems to have stair-stepped upward and done quite a bit of trading between 193 and 213. It's had a swing back and forth between 213 and 233, And we find ourselves right now at a possible area of support, a price floor. There was previously a price ceiling around that 193 level. And let's say that our trader's outlook, as they're maybe planning a trade out here for the August expiration, that's the August 21st expiration there on your screen. Oh, and by the way, the stock has started to move even as I was launching this webcast. In any case, let's say that their expectations, maybe price is going to continue up from this 193 level as it seems to have done in the past. And maybe their outlook is that before August 21st, possibly price can stretch itself back up to 213. Is that guaranteed? Of course not. But that's the basic premise for today's discussion. So let's say our trader hops over to their option chain and they're going to buy a call option. Well, if they do that, there are three primary variables that can influence the success or failure of that trade. So let's go here to our options chain on the trade tab. I'm going to go down to the 21st of August. That's right here. And let's say with the stock trading around for about just a little over 198, let's go with maybe the at the money contract, the call at the 197.5 level. Looks like it's trading. Ooh, look at that, right about $9. That'll give us a nice, easy number to work with. So here's our example trade. We're going to buy a long call. So in this case, we're buying the 21st of August, 197.5 call. And it looked like it was maybe going to cost us around $9. Obviously, the trader never knows until they place that trade, see if they can get a fill exactly how much they may be paying. It looks like it may be a little bit less than that. That's okay. I'm going to leave it right at $9. It looks like it might be closer to $8.75 at the moment. Shadow, that's a good question. It's a little bit off topic for this discussion, so I'm just going to keep the discussion on track, and we'll focus on options today. My apologies if I do appreciate questions, but if they don't tie really directly into the discussion, just in the interest of keeping things linear and keeping the education moving forward, I may have to sort of stick a pin in some questions for other discussions. Anyway, but let's say this is our trade that we've decided to place. And by the way, we're already seeing price fluctuation in action. What has moved the price of this call option from $9, which is where it was just a few minutes ago, to $8.75-ish, which is where it is right now? Well, that might be explained by a combination of three variables. Yes, what happens with the stock price is one of those variables. As the stock price goes up, a call option will tend to increase in value. As the stock price goes down, call option will tend to decrease in value. But also, as time goes by, we start to lose some value on that call option. And as volatility levels shift, as the outlook for how much a stock might move over the time frame of the contract changes, that can influence the value of the options. So we have three variables: price and time and volatility to keep our eye on. And for options traders, the lens they use to look at those variables, to peer at those variables, is the options Greeks. So if you didn't understand that, that's okay. You don't have to understand everything right out of the gates with options trading. I'm going to try to connect those dots for you today. But I want to start to explore our options Greeks. So the first thing that we need to do is add those to our option chain here. So right now we're seeing a few columns here. We have the bid and ask price. These are basically, we might think of this as just the trading prices for options right now. Those are static. Those are always going to be there on our options chain. But over here to the left, we have two other columns. By default, by the way, these might be the default columns the first time you log into Thinkorswim. The last price and the net change. So that's just the last price the option traded for and the net change for the day, up or down in basically dollar amounts. So, okay, Scuba says, why the at the money call? It's a good question. So strike selection we'll focus on in a different webcast. We've actually done that. We've done that before. We'll do it again in the future. But for today, I just went with the at the money just to keep the conversation moving forward so that we can focus on the Greeks rather than on strike selection. It's a legitimate question. It's just I kind of prioritize what I'm going to cover from one webcast to the next, and then we just try to get really good at that, whatever that item is for the day. All right. So back to our columns here, the bid and the ask just are always displayed on the options chain. The other columns here are customizable. So what I want to do is let's replace the last price, the X just stands for price, last price and net change. I'm going to add our option Greeks. So I'm going to come right down here in the menu just to where it says last X and net change or whatever the current column set is. There's a menu heading that we can click on, and we're going to choose the Greeks, delta, gamma, theta, and vega. And that gives us, for each of our strikes, 4 columns of different numbers. These numbers are really critical to understand in order to be speaking the language of the options trader. George says, is not the option implied volatility back calculated from options pricing? Not the other way around. It's kind of a chicken and the egg scenario, George. They both essentially happen simultaneously. So I can't really tell you which comes first, unlike the chicken and the egg. But getting back to our Greeks here, we have delta. This is a little bit crowded. Delta, gamma. Let me see if I can borrow a little bit more space. Not quite. Here's another technique we can use. Notice my gamma column here is a little bit crowded. It just says GA, and then it has dots to indicate that we can't see it all. Here's a little technique. If we need more space to see all of our columns that we've loaded up here, we can go right up here where it says sides both. Right now we're showing calls and puts. We're not going to be talking about puts today. Let's just remove the puts. So we can go from both to let's just show the calls. There we go. That gives us more space here. So we have delta, gamma, theta, vega. This does shift, so you kind of have to do a little eyeball shift here. The strike price that we're discussing, instead of being to the right, is now going to be to the left. All right. But in any case, let's talk about delta. Some traders refer to this the king of the Greeks. And what I'll do, maybe to keep these static, because they're not static numbers. These will change. The markets are open as we're having this webcast, and you'll see these numbers shifting every once in a while. So let's make a quick note here. Delta right now is 54 cents. Or 54 is a better way to put that. Gamma is 0.02. Theta is a negative 0.19. And our vega is right now 0.20. So we really need to understand what these are. And once you understand them, you'll recognize the significance essentially immediately, right? So delta, some refer to this as the king of the Greeks. Delta starts with D, so does dollar. And that's a little memory device that I use to remember the implications of delta. Delta, each of the Greeks makes an assumption about one of the variables that influences the price of options. Delta makes an assumption about what happens with NVIDIA's price. Delta starts with D, so does dollar. The assumption here is that the price of NVIDIA goes up $1. And delta tells us the potential impact there on the value of our contract if we got that $1 increase in price. So here's the direct math. If we just bought this contract for $9 and then NVIDIA's price goes up by $1, how much did we just make on our option contract? 54 cents. I know it says 53 right now because things are changing. Markets are moving. That's okay. But a delta of 54 tells us if stock goes up $1, we make 54 cents on our contract. Now that's actually a big impact on the value of that contract. A $1 move on NVIDIA is basically it's a $200 stock. So it's about 0.5% move on NVIDIA. It's a relatively small move on NVIDIA, has produced a 54-cent unrealized gain on our call. Ooh, on a $9 contract, what percentage is that? Let's get our calculator out here. 54 cents divided by $9. is a 6% return on a 0.5% move on the stock. That really gives you a good insight into the leverage available on these contracts. But that's really the implication of delta. Now, another thing it might tell us, I need to give this credit, delta can also tell us the relative likelihood that our stock will be above our strike price at expiration. So 197.5, there's about a 54% chance that will be above 197.5 at expiration. Which kind of makes sense. It's already above 197.5 right now. So yeah, about a 50-50 chance, a little bit better than 50-50 since it's already there. But that's the fun side of delta, if the stock goes up. Well, what if our stock goes down? We can actually employ delta again to gauge how much we might lose on a $1 move downward on our stock price. So if our stock drops $1, the assumption is we lose 54 cents on our $9 investment, and we just lost 6% of our value. So yes, delta, you can see how it's a powerful number, and for some they call that the king of the Greeks. However, it's not the only variable here. Shadow price says, do adjusted contracts affect the Greeks or just the liquidity of that option? Shadow price, or shadow Pico, I would assume you're talking about adjusted contracts, meaning for stock splits, for dividends, and for those sorts of things. It does definitely affect the Greeks. Yeah. Because, for example, adjusting for a dividend, well, a dividend payment can move stock price, which is going to move our contract either further in the money or out of the money, depending on whether trading a call or a put. And those different strike prices, deeper in the money, have different Greeks. They have different deltas. Further out of the money, also have different deltas. Yeah. So all of that can definitely affect Greeks. But it's, just built into the equation. All right. So that's delta. Let's move on to gamma. Gamma, I think for some traders, I definitely relate to this. It's probably the heaviest lifting we have to do with understanding one of these Greeks. It's possibly the most complicated. Now, is it terribly complicated? Not so much, in my opinion, but it does take a little bit of extra mental energy. So what is gamma? Well, for some, they refer to gamma as this is going to sound like a lot, the rate of change to delta. What we just need to understand is that delta does change. Sometimes it goes up, sometimes it goes down, and this is basically how fast it goes up or down. But the direct implication for delta, or for gamma, pardon me, is let's say we have a $1 move up on the price of NVIDIA. Well, we know that our call should increase in value by about 54 cents, assuming our other variables hold constant, if it's just price moving up and down. Well, what about the next $1 move? Well, our stock has, in this case, it will have positioned our contract a little bit deeper in the money. Our delta is going to be a little bit different. And this is how much different? 2 cents. So to put that more simply, if the stock goes up $1, we might anticipate a 54-cent unrealized profit on our call. If it then goes up a second $1, we add 2 cents to the 54, and that second $1 should create an unrealized additional gain of 56 cents, 54 plus 2 cents. That's it. It's the rate of change to delta. But it can still be powerful, not as big of a deal, but it just helps us start to project further or larger moves for our stock. So there's delta and there's gamma. If this is your first exposure to that gamma Greek, this is one of those where it might be useful to go back and watch the archive and really process this, maybe look at a few examples on some different options chains and do some math. I'm going to give us the opportunity to do some math on this in just a few minutes to really make sure that we've cemented our understanding of these Greeks. But there's delta, there's gamma. Finally, we have theta. Not finally, but next we have theta. Theta starts with T, and so does time. So theta is the measure of how much the passage of time is impacting the value of our option. So let me set up a scenario for you. Let's say that we buy this call right now for $9. It right now has 24 days on the contract. And then we're all excited because we think the stock is going to go up. And we wait, we check on our account tomorrow, and NVIDIA has done nothing. It's just gone straight flat, hasn't moved at all. So Delta isn't doing anything for us. All we know is that yesterday we had a contract with 24 days of potential on it, and we wake up today and there's only 23 days left for the stock to get up and start to do something. Well, the passage of that 24-hour period has had an impact on the value of our contract. And you can see it has the minus sign there. It's a negative impact. The assumption here is that one day goes by, and that day would reduce the value of our contract by 18 cents, previously 19 cents. Notice it's changed a little bit. Kevin says, Cam, does gamma increase the closer to expiration? Yes, it certainly can, Kevin. That's actually because what happens is we get closer to expiration, time and volatility don't play as large a role. Delta and gamma start to really take over. Yep, gamma does dial itself up there, Kevin. Yep. In any case, theta is that gauge of time decay. So yeah, if we buy this for $9, the stock doesn't budge, but 24 hours goes by, the assumption there is we just went from a $9 investment, it's only worth $8.82 after that one day. Or if we're using the Greek that we first jotted down, $8.81. So that's the passage of time. And notice it's not evenly distributed. The heaviest time decay tends to happen on those at the money contracts. We tend to have less time decay as we get further out of the money on our contracts. That's just because the contracts they're smaller contracts. So that time decay, that bottom line time decay is also smaller. As we go in the money, there tends to just be less time value in the contract, and delta plays the bigger role. All right, now finally we have vega. Vega starts with V, so does volatility. This one I think also takes a little bit of extra mental load to understand, but this has to do with the way that options are priced. We have to understand that. Options on stocks that move a lot tend to be more expensive because options speculators tend to see, let's say, more potential in all that movement. Options hedgers might see more risk in the stock, and therefore they're willing to spend more to hedge that risk. But there tends to be greater demand for more volatile for options on more volatile stocks, and therefore the price goes up. Now, if the volatility starts to settle down, the price of those options will tend to come down. Even if the stock itself isn't moving dramatically higher or dramatically lower, even if time isn't passing, if the expectations for volatility of the stock over the time frame of the contract start to settle down, we'll see the value of the option drop. Or if traders start to get more excited about the prospects for the stock to really start to move during the time frame of the contract, the value of that contract will tend to expand. So here's the bottom line for Vega. It makes the assumption that volatility increases, or expectations for volatility increase by 1%. And that 1% increase has a positive impact on the value of our option to the tune of 20 cents. So let's look at it this way. Let's say that we buy our contract for $9. It has 24 days on it right now. Let's say it's still today. The stock price hasn't started to move, and yet maybe traders get wind of some new news that's going to be announced we didn't know about before the end of our contract period. And they think, oh, this could really cause the stock to move, and their expectation for volatility starts to rise. Well, that will increase the value of options. And in this case, to the tune of 20 cents. That's on a 1% increase in volatility expectations. So Vega starts with V, it's volatility. So there are your three variables. We can measure how much impact price will have on the value of an option. We can measure how much impact time will have on the value of an option and how much impact volatility will have. And notice I'm saying the word will, not might, but will. That is if our assumptions about price, time, and volatility are accurate. So let's make a few assumptions here. Let me throw out a scenario, see if we can do the math here, see how much we've really processed the way that the Greeks might be used. How about we keep it pretty simple, and then I'll sort of complicate it a little bit more. Let's say that we buy this contract right now for $9, and tomorrow our stock has gone up $1, and volatility has increased 1%. All right, that should allow us to introduce all three variables into this equation. Stock price of NVIDIA goes up $1 by tomorrow, while volatility, implied volatility, expectations for volatility go up 1%. Let's do some math. So we bought this for $9. Let's deal with the tomorrow part first. No, let's deal with the delta. Let's deal with price first. Stock has gone up $1. Great. So we have $9. Stock goes up $1. Our delta is 54 cents. Delta projects that the value of our contract will go up 54 cents as a result of that $1 increase. However, this happens by tomorrow, so a day has gone by. So we have to subtract the 18 cents for our theta, our time decay. And finally, expectations for volatility have gone up 1%. Oh, well, then we can add in our Vega of 20 cents. And what's the bottom line? I haven't done the math on this yet, so $9 plus 54 cents is $9.54, minus 18 cents is $9.36, plus 20 cents is $9.56. Did I do that math correctly? Is it easier to see it on the screen here if I do it this way? $9 plus 54 cents minus 18 cents plus 20 cents is $9.56. That would be the expected value of our contract tomorrow if the stock has gone up $1 and volatility expectations have gone up 1%. And it's not just a projection. It is extremely accurate, assuming our assumptions were accurate, right? Maybe the stock doesn't go up $1. Maybe it does, but it takes 2 days to do it. Maybe it does, but volatility levels drop. So if our assumptions are correct, then our math is correct. Bogus Chinchilla, my math says it's 9.56. Let me know if I've done anything wrong here, though, and please let me know why. But also, just so you know, I am using the Greeks that we wrote down. Oh, you know what? See, I didn't use the Greeks we wrote down. I actually put in the wrong theta. I looked at the chain. So maybe we need to, this is where someone else said 9.55. You were right. I was off by a penny. Because using the original Greeks, to be fair, I said I was going to use those, so let's use them. These ones are actually accurate as of right now. If we wanted to, you know, if we didn't mind just constantly changing our projection, I didn't want to do that. I wanted to use static numbers. So thank you, Paul, you were right. I was wrong for that reason. Okay, so let's stick with using the Greeks that we've written down, and let's get a little bit more complicated. All right, well, let's assume our stock goes up $2, but it takes 3 days. And at the same time, volatility levels drop. Let's say volatility expectations drop 2%. We're going to be getting a little bit dicey here. I can't remember my proposition. Yeah, up $2. Okay, so up $2 would mean how much do we make on the first one? Let's get our math here. First dollar, we make 54 cents. Second dollar, how much do we make? Well, make 54 cents plus 2 cents. The gamma is our rate of change to delta. With the stock having moved $1 already, the new delta is going to be different. It's not going to be 54 cents anymore. On that second dollar, it's going to be 56 cents. All right. Now, I said, let's assume that it took, did I say 3 days? Let's do 3 days. We have 3 days of time decay. Let's get our calculator. 3 days of time decay, it's going to be 57 cents, but I'll just show it here, times 19 times 3 is 57 cents. So we have to subtract 57 cents in time decay. And I said expectations for volatility drops 2%. Well, instead of seeing an increase to the value of our option by 20 cents, it would be a decrease to the value of the option by 40 cents. The Vega always assumes that volatility goes up. That's positive. It inflates the value of contracts. If volatility levels drop, that's negative. It deflates the value of contracts, and this just tells us how much. But I will say, with each of these, I'm going to put a little asterisk here. Little asterisk right there, little asterisk right there, because these are approximations. These are really only estimates, because actually, as the days go by, time decay changes. As volatility levels rise or fall, the impact of Vega actually expands or contracts a bit. But in any case, this is close enough to probably be serviceable. Let's see how much our contract is worth. $9 plus 54 cents plus 56 cents, that would put us up to 10.10. Minus 57 cents would put us back to $9.53. Minus another 40 cents would put us back down to $9.13, wouldn't it? Let's do it up here in our calculator to double check our numbers. $9 plus 54 plus 56. The price is moving in our favor. Everything is great. Oops, except we got to subtract time decay using our theta. And we need to subtract that falling volatility. And after just 3 days, our stock has gone up $2 and the value of our contract has barely even budged. This is when somebody picks up the phone, they try to call Cameron. I'm not available by the phone, via phone, by the way. But let's just suppose this is hypothetical. Somebody calls me up and says, Cameron, your delta is broken. I bought a call option. I learned that calls make money because if the stock goes up, we've leveraged that and now we're making tons of money. And yet the stock went up $2 in just 3 days and I'm barely breaking even. What's going on? Your delta is broken. No, my delta is not broken. We just have to factor in the other Greeks as well. All right. Let's see. Zink says, Cam, do you usually check the today's option statistics before entering? Some may. Zink, you've asked another good question. It would require me, though, unfortunately, to go and explain what the today's option statistics are, and then explore the pros and cons of each of those statistics, and then say yes or no. So unfortunately, I can't give you a very good answer right now. Not every options trader checks those. There can be good reasons to check them, but for some, it may not add important information to whatever they're trying to accomplish. So it's a good question. Once again, one of those where I'll just have to sort of park it. It's just a little bit too far afield from this discussion. But this, I think, is providing really significant insights into how options really work. And as enthusiastic as I am about that, because this is real stuff, it does have limitations. Notice the little asterisks here. This is what I will say here is over the course of 3 days, there will be approximately 57 cents of time decay. It's probably going to be a little bit more than that. If volatility levels or expectations were to drop by 2%, there would be approximately a 40-cent drop in the value of our option. The difficulty is that Greeks are intended for conditions as they stand right at this moment. forecasting how things are actually changing next week or next month when prices have already moved, well, the Greeks are going to be very different. So forecasting that third, fourth, fifth, sixth dollar, or that third, fourth, fifth, sixth, 20th day, or that second, third, fourth, fifth percentage move down in volatility, that's where the Greeks start to lose some value. Teach to Fish 2 says not seeing where you got the 57 and the 40. So 57 is 3 days of time decay. So it's 19 times 3. And the 40 is 2% drop in volatility. So it's 20 times 2. That was it. All right. So that's where those come from. But wouldn't it be nice if we just had a calculator where we could just pump in some assumptions about what price, time, and volatility are doing, and it uses the Greeks automatically to do all these calculations for us, because this is a little bit of a pain to run through these sorts of equations. It uses up mental space. It's using up physical space in my Scratchpad right now. Well, there is a tool right here on the Thinkorswim platform, right up here where we have delta, gamma, theta, and vega displayed. We can use a tool known as TheoPrice. Really what we're trying to do right now is we have current price of options, and we're trying to figure out future theoretical prices based on changes in price, time, and volatility. Well, the theoretical price tool allows us, this really is just a calculator that does all of this Greek's math for us. Now, there's a reason why I didn't show you the calculator first. That's because I do think it's important to understand the Greeks. The Greeks are the language of options traders, and they have, as you progress in your understanding of options trading, you'll really see how frequently those Greeks are referred to and how many different important insights they can bring to trading options. But let's use our TheoPrice calculator now. Now that we understand the Greeks, when we choose TheoPrice here as one of our columns, this is telling us, right now it's just telling us the current value of the option. So you'll notice, oh, actually I need to do a quick reset here. I've used the TheoPrice tool in the past, and the variables that I've changed are still changed in there. Let's click reset in our calculator. There we go. But as we look at the 197.5 strike, let's look at our calls now. And there's our TheoPrice column. It says 827. Well, that's just where the price of the option is right now. It's between 820 and it was 835 there just a moment ago. But this can also show us future expected values of our contract based on changes of price, time, and volatility. Let's go up here now and click on this calculator. So as I click on this heading, I get this pop-up which allows us to enter variables for price right here, time up at the top, and volatility adjustments down at the bottom. And let's put in this same projection that we had earlier. Now this is going to be different because price has already changed. The stock was it's fluctuated between 197 and change and 198 and change. But let's just assume that let's say by next week, today's July 28th, let's go out to Tuesday of next week, August 4th. Let's say that we think maybe our stock is going to pop up there, who knows, $5. So we're going to put in a 5 for $5 for our stock price adjustment. Yes, we could put in $5.50 if we wanted to be, let's say, more nitpicky with the stock price. We can also put in a volatility adjustment. Let's say that our volatility level, maybe it increases 3%. There we go. So put in a 3. So notice this is a calculator where we can put in our expectations for price and time and volatility and just hit enter on our keyboard. And what this is now doing is projecting for us that future expected value of our contract. So right now we might be able to buy a contract for about $8.40. And if the stock were to go up $5 by next Tuesday, while volatility went up 3%, the expected future value would be about $10.50. Very nice tool. And what's happening behind the scenes here is the Greeks are at work. And our calculator just knows how those Greeks, what they are and how they change as our variables change. So that's a nifty little tool. But with that, and we can change the variables here. What if the stock price fell $3 and volatility dropped 2%? Well, it's not good. We paid, let's see, there's our 197.5, paid $8.50 for those calls. They're only worth $6 now. Yep, powerful tool there. But guys, this is our introduction to the language of trading options. And yeah, the native tongue of the options trader is Greek, or in other words, we use the Greeks in trading of options. And there's your introduction to delta, gamma, theta, and vega. I hope you enjoyed this discussion. This is in this Tuesday series, this is what we do. We talk about getting started with options. My apologies, there were some great questions that came in today. Some of those were just a little bit too far off the topic of what we were addressing specifically today. Tried to do some of those, some justice, but not always possible. But everybody, we're going to do this again next Tuesday, but between now and then, we have a range of other topics that we address. We have a whole staff of coaches here that are delivering webcasts on a range of trading and investing topics all throughout every trading day. I have a new webcast every single day of the week. As long as I'm here, I'm not on vacation. I had a question, as a matter of fact, about one of my other webcast series that came in the chats before the webcast started, and I promised I would address it. So here's a quick navigational tip for getting the most out of Schwab Education. First of all, make sure that you have subscribed to our Trader Talks channel on YouTube. Our channel there, and you can subscribe just by going down below the video stream. Click on subscribe. It doesn't cost anything to do that. It only takes a second. But this is where you can join our live streams. You can find our playlists of previous webcasts, or you can even do keyword searches. So the question earlier was, hey, Cameron, have you ever addressed in my webcast series, it's called Getting Started with Thinkorswim, have you ever talked about the probability analysis tool? Yep, I sure have. And a quick way to find that, just type in the keyword probability, and you'll see that James and I have both recently done webcasts on this topic. I get to that tool occasionally, but this is the one that I would suggest, understanding and using the trade probability tools on Thinkorswim. So that's a nifty feature of the YouTube layout. You can do a quick scan for a topic of specific interest, or you can just find the playlists of previous webcasts organized by series. So if I click on playlists here, this webcast series is actually all the way down toward the bottom. We have so many different webcast series. Here's mine, Getting Started with Options. I can click on View Full Playlist, and there's last week's discussion. Top reasons to skip a trade, and keep looking. Now, another thing that Kevin and I would like to suggest that you do is to follow us on social media. You can find Kevin and me on X. You can find us on LinkedIn. You can find Kevin there on X at Kevin Horner CS. You can find me on X at Cameron May CS. And I do post on there frequently. As a matter of fact, I just posted a new video this morning, 2-minute video. And if you reply to those posts, I just try to reply right back to you. I do the same thing over on LinkedIn. So if you go to linkedin.com/in and then /Cameron May CS, that'll take you to my profile, and you can reply to my posts here, and I just try to reply right back to you there as well. Now, I also noticed there was, I think there was a survey, wasn't there, Kevin? Yep. Yeah. So if you would do me a favor, if you're here in our live stream audience, click on that survey link. Give me some honest feedback. It's always appreciated. Yeah. If you haven't ever filled out one of our surveys before, they're super short, 2 questions. And then there's a comments box and a suggestion box. But I always read through that data. I read through your comments, I read through your suggestions, and it helps. So it's never a wasted effort. So thanks for filling out that survey. Kevin, thanks for reposting. Everybody, thanks for all the thumbs up. That's very much appreciated. That's a nice pat on the back to your presenter. And it gives me a nice boost in the YouTube algorithm so more people can find these videos. But guys, time for me to let you go. Go enjoy the rest of our educational offerings. I will see you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.